May 7th, 2024. We had some pretty fascinating stuff happen towards the end of the day, I think. Um, you can see that the open of the day, you can see this price, the open of the day, was the same price as the midpoint of the day. So what does that mean, right? Why is that important? You can see it shows it's off by like a half a tick, but because it's in between the two ticks, so I just rounded up to that tick. So what does it mean, right? That makes it a more obvious magnet when the open of the day and the midpoint of the day are the exact same price. And since it's a trading range day, you know the open of the day and the midpoint of the day are going to be magnets. And since it's the same price, we're probably going to get there. So if we're probably going to get there, well, you have to be thinking about that towards the end of the day, right? Because I'm just going to leave this up here. We're probably going to get to this price, and the traders know that the low of the day is probably in. So the next question you have to ask yourself is, what's the midpoint between the low of the day and the open of the day? And it's about right here. And you can see during bar 73, that's when traders were starting to think we were going to get the bounce, and they started buying at that price, and we got a rally initially. And then we sold off again, and traders bought it again. Why? Because 60, maybe even higher than 60% chance that we're going to test this open of the day because it's such an important magnet, with it also being the midpoint of the day. So traders were buying during 72. They ended up scalping out. They buy again during 75, and you can see that's why we got that rally to the open of the day. But this probably wasn't a very good buy the close rally, considering that this was the magnet we were going for. So once we reached it, most of the edge for the bulls was gone. But I just think it's really interesting that you can see traders know buying this midpoint, in this reasonably tight bull channel. They know buying here that probably at least a 60% chance we're going to get here before we get here. It's towards the end of the day, so we need to rally relatively quickly. That's exactly what happened on bar 76. Bar one, a big bull bar, but a big tail on the top, not as good as it could be. Big tail on the bottom as well, so probably going to be relatively sideways and expect the trading range open. We've had a lot of strong rallies over the past couple of days, so I think we're probably going to have a more sideways day. Bar two, an inside bar, low one short for the bears. The bulls see a pullback in the bull trend that started late yesterday. An inside bar three, so we have an II. You could argue that bar one and the gap up were a buy climax, and when you get a buy climax and then an II, sometimes you get a sell off. So it's probably reasonable to sell below three and bet that it's the high of the day. But I personally wouldn't do that. I think that it's better to just wait and see the follow through. But a lot of traders, instead of selling below three, choose to sell above three. And you can see that ended up being a profitable trade because bar three, although it was an II, we're in breakout mode, right? But it's essentially a high one for the bulls, and it's not very good considering it's a bear bar. Big outside down four. I think we're in a trading range at this point. Probably going to be a pretty sideways open. And a reversal up on five, it's a high two on the open. So the high one was above three. It's a high two above bar five. A lot of times you get high twos, low twos on the open, and they can definitely be credible lows or highs of the day. But I think that it's better to wait at this point as you're buying basically right at the open of the day on a probable trading range day. Bar six, a bear bar closing near its low. It could be a third leg down. So 2-3 was the first leg, and then we traded above three during four and then back below it. And then you can see five was the high two, and then almost outside down six, but that's the third leg down. So I think it's hard to sell six. You're probably going to end up losing that trade if you take it. It's maybe not the worst trade in the world, but it also doesn't break out below bar five either. So that you're selling low in a trading range on a bar that didn't break out, and it's a possible third leg down. So it's really not all that great. Seven, a big tail on the top, but a wedge. 1, 5, 7, or you could say 2, 5, 7. Either one is fine. Possible low of the day at this point, but a big tail on the top. So probably better to wait. But I think credible if you're just going to hold and hope it's the low of the day. Follow through for the bulls on 8, but a big tail on the top and the bottom. So really not as good as it could be. One of the other problems with selling below 6 is it's a trading range open. And in trading ranges, traders are going to be able to scale into trades to make money. So if a trader bought the 5 high as a high for a high 2 on the open, and they're willing to buy more below 5, you have to bet that we're probably going to get back to the 5 high. So it's hard to take a sell like 6 thinking we're going to get back to that 5 high. Bar 9, it's more follow through for the bulls, but it's a bigger bar, relatively climactic. It might lead to some profit taking. This is not really a very strong rally from 7, 8, and 9. So I think that we're going to go more sideways. The channel down to bar 7 was relatively tight as well. So I don't think we're going to end up getting some sort of huge rally here. And if we were, we'd be getting better bars. Doji bar on 10, relatively disappointing follow through. And then big outside down 11. Bear bar, you can see it's testing back to around the 6 close or around the bottom of this buy climax. 12, an inside bar, a low one short for the bears, but I wouldn't sell it. I think you're selling low in a trading range. It's a lower probability trade. I'd rather wait and see what we get. 13, disappointing follow through. And you can see if you did sell 12, those traders, they used 14 to just get out. Why? Because if you're selling and you get 13, that's not what you wanted to see. If you're selling a bar like 12, you need to see a bar that looks somewhat like this, so like bar 6 as follow through, because you need fast follow through selling a low one relatively low in a trading range. So the traders who are doing that are disappointed in 13 and they're quick to get out on 14, causing the bounce. Probably better to sell above the high one, bar 12, than it is to sell below it. And, in trading ranges in general, if a trade looks okay, kind of okay, but not that great, like buying about 5 or selling below 12, it's probably better to take the limit order trade, below the bar, or the limit order trade above the bar, than it is to take the sell or the buy there. 14 is a low two for the bears. Because they see this as a new bear breakout, right? So they want 11 to be a bear trend, a low 1, 12, and then we get a pullback, and then the low 2, 14. But it's not very good. It's a bull bar towards the bottom of the trading range. Bulls see that 7 through 9 was the start of their bull trend, and they think that 11 and 12 is the first leg back down in a two-legged correction, and the second leg down is essentially 15. Who's it better for? I think we're probably a little bit more bullish since we're always in long. I don't think we've flipped to always in short, so I give the bull argument a bit more credit, especially since it's not selling a low 2 at the bottom of the trading range like it would be on 14. 16, a surprise bar for the bulls and good follow through on 17. I think it was okay to buy above 16, but there was a tail on the top, which was mildly disappointing. But 17 did close above the high of bar 1, which was the breakout point. So I thought it was pretty important that 17 was able to close up there. And we're probably going higher. More follow through for the bulls on 18, but a bit of a disappointing tail. And then a bear bar on 19. Do you have to get out below 19? I don't think so. It's a first reversal, and this is strong enough for a second leg. And, on trading range days, so just in general, buying above this, 60% chance you're going to get, a measured move up here, something like that, right? So you can probably buy the close of 18, go for the measured move, and you're going to win 60% of the time. But if it's a trading range day and there's a lot of trading range price action, sometimes you end up getting more of a leg 1, leg 2 measured move like we got today. So from the low of 16 to the high of 19, the first leg. And then you can see the low of the second leg, 41, to the high, 49. So it ended up being a leg 1, leg 2. We also got a measured move up of this trading range here. And that's where that high was. It's not really that important to sit there and try and pick all the measured moves out. I think it's just fun to do. So I do that sometimes. They're important to recognize, but trading more based on the bars, I think is, don't fade moves based on measured moves. It's more a profit taking area than anything. So don't try to, take the measured move up that I just showed of the trading range, and then you get short during 19 for like a scalp or something, because that's just really not a very good idea. Probably buyers below 19. I expect the second leg sideways to down, but I don't think we're going that much lower. You can see 20, not really ideal follow through if you had sold below 19. And we start to get a second leg up, 21, and then a bear bar closing near its low, 22. 22, I would not sell. I think it's a tight trading range. It's really risky to take that kind of trade when you're selling low in a tight trading range after, 16, 17, 18. So 3 really strong bull bars, and now you're selling low in a tight trading range. That doesn't seem ideal. Big doji bar, 23. And kind of disappointing follow through if you had sold below 22. 24, again, touched the same price that 21, 22, 23, and 24. So they all have the exact same high. When you have 4 bars with the same high, it's called a ledge. They're pretty rare nowadays. I remember Al saying that back in the day, he said like in the 2010s and 2011, so some time ago, when the Emini range was a lot smaller, ledge patterns were pretty common. And what it means is when you see 4 bars with the exact same high or the exact same low, there's an 80% chance that you're going to trade above that price and then come down back below it within 100 bars. Now, I know you probably hear that. I know the first time I heard that, I was like, great, like, who cares? Within 100 bars, you know what I mean? That's a lot of time. But it's important to just keep those things in mind, because a lot of times it does it a lot faster than that. And it's a pretty rare pattern nowadays, so it could have an even greater magnetic pull. So we have a ledge top, and 24, you can see, you could argue it's some sort of low 2, low 3 for the bears, but I think that bulls are out below 22 for sure. But it's hard to want to sell 24. It basically just looks like consecutive doji bars. 25, a bear bar, but not really a very good close. Big tails on both sides. To me, this looks like a deep pullback, and we're going to get another leg up from 16, 17, and 18. 26, it's a big doji bar. I would argue essentially a big high two. You could say the high one was 20 for the bulls, and it's a big high two, but it's a big doji bar. Bull bar closing near its high 27. Do you buy above 27? I don't know. Maybe you can. You do still have an open gap with yesterday's high, so I thought that was important. And there was a body gap here that was open. So we do have two open gaps. Maybe we're going to rally. But this doesn't really look exactly like the way I would want a small pullback bull trend to look. 28, doji bar is follow through. So if you bought above 27, now you have a doji bar is follow through. And if you bought above 27, your risk probably has to be below 25. So you have a big stop and your probability is not all that great because you just got a doji bar. So I think it's really hard to stay long here. Another bull bar 29, it could be some sort of second leg trap. We're back in the middle of the tight trading range from 19 to 24. Tight trading ranges are magnets, so the market often gets pulled back into them later in the day. 30, a bear bar, but essentially more of a bull reversal attempt. You can see we traded back down towards the 25 close, but we weren't quite able to get there. And traders were buying on the way down. Why? Well, they didn't want to buy all the way up top, like the close up here, because you have really big risk. So as their risk got smaller and smaller, they were more and more willing to take the buy. They know the probability might not be as great, but it's a trading range, so odds are we're going to get a bounce. And they know they'll probably be able to scale in as well because we haven't traded below the moving average yet today, right? So the first time you trade below the moving average on any given day, there's probably going to be buyers there. And you can see 31, an inside bar, a high one for the bulls, but I don't think it's all that good. It's a bear bar. So for me, I would rather just wait and see what happens. 32, a bull bar, but it could be three pushes up, 1, 2, 3. I'd probably just rather wait at this point. We could be getting some sort of wedge to 1, 19, and then maybe 33, something over in here. So I think for the most part, it's difficult to be long up here. 33, a bear bar closing near its low. It's a truncated wedge with 1, 19, and 33. But I'm not selling it. To me, it looks like a tight trading range. And you're selling in the spot where bulls have been buying recently. So bull bar closing near its high 34. I don't think it's really a great buy. It's kind of tough because we're always in long. It's a bull bar closing near its high, but you're buying the top of a 3-bar tight trading range, so it's really not as good as it could be. 35, a bull doji bar. It didn't end up triggering the buy above, but you're buying really high in what's probably a trading range. And then we had 36, a bear bar closing near its low. This is probably one of the better sells of the day. You can see we have a wedge, 1, 19, 36, or 33. And we have a nested wedge, 27, 29, 33, or 36. You could argue it's a second entry for the wedge. So I thought 36 was a pretty credible sell. It's not very high probability because it's a very small bar, but it's definitely a reasonable sell for a minor reversal. Why a minor reversal? Well, we haven't traded below the moving average yet today. And the first time we do that, like I said, there's going to be buyers. So I thought we would probably trade below 36 and we might get some sort of bear move, but it's probably going to end up being a minor reversal. We had a couple of nested wedges today. You can see we had this nested wedge here and here. So 18, 25, 41, and 34, 38, 41. So a couple of nested wedges, and you can like the one I just talked about. Nested patterns are pretty cool. 37, a big bear bar closing near its low. What is 37? 37 is bulls giving up on the small pullback bull trend. I don't think it's as much bear selling. Obviously, it's always both, but I think this is more just a give up bar for the bulls. Does that mean we're going to get some big measured move down right now? No, I don't think so. I think that, bulls are probably going to buy because now they're getting a chance to buy it at a discount. And for the bears, if you sold below 36, you just made basically 3 points and you have basically zero true risk, right? So I think for a lot of traders to take profits on the close of 37. You know that 36 and 37 is strong enough for a second leg down, but you don't know what the second leg is going to look like, and the pullback could be relatively deep. So if you sold below 36, are you going to be able to sit through 38 and just stare at it as it goes that far against you? It's kind of hard to do. So a lot of traders just took profits, and that's what causes 38. 38 is a double bottom with 27. I'd rather wait at this point and just see what happens. What the bulls want is a breakout above the wedge. Again, the wedge being 119.33 or 119.36. And they want to measure move up. The bears want some sort of lower high major trend reversal. 39, a big doji bar essentially. Bad follow through for 38. I wouldn't buy above 38. I think, like I said, we're probably going to get a second leg sideways to down. And you can see any trader who sold the close at 37 is obviously disappointed in 38. Maybe they scaled in more at the 36 low, and they're using the sell-off on 39 to exit their shorts. And the same thing on 40, traded back down here again, and traders bought back their shorts yet again. Bear bar 41, but a big tail. Looks like 3 pushes down to me. Like I said, nested wedge and a reversal up 42. You can probably buy above 42. It's a midday reversal, but in a nested wedge. But my big problem with it is you're buying, kind of high in the trading range, and you're buying on a flat moving average. So none of those things are really all that great. Follow through on 43, but a big tail on the top and just not ideal. More follow through for the bulls on 44. But it could be a 1 pullback too, so it could be 2 legs up. 45, a bear bar. In my opinion, at this point, everyone's waiting for the breakout. You can buy above 44 probably, but I think at this point it's better to just wait for the breakout and see if it gets follow through. And if it does get follow through, great, you buy then and you trade the follow through. If it ends up failing, then you trade the reversal. 45, disappointing. I think it's kind of hard to stay long if you had bought. And that's kind of one of the problems, I think, with buying high in this trading range is it might go a little more sideways before it goes up. So I just thought better to wait than take that buy, but definitely reasonable to have taken it. 46, a bull bar, but a big tail on the top. I think, always in long, bull bar, it's probably okay to buy above 46 and follow through on 47. So we now have the breakout. It's a breakout attempt for the bulls, and they want to get the measure to move up, and they get the good bull bar on 47, but they need consecutive good bull bars. So what is 48 going to look like? And the minimum that bulls wanted to achieve was not a bear close, right? So even if it was a perfect doji bar, it would still be considered follow through for the bulls because it was a non-bear bar. And instead, we had a bear bar 48. So in the beginning of what was supposed to be their trend, you would argue the trend started at 42, but really in the beginning of the breakout, you want the market to be relatively strong. And on their first real test, the bulls were not even able to get a non-bear close. So what happens? A lot of the traders sell out of their longs and you get a reversal down 49. Tight channel up here, so it might go a bit more sideways before we go down, but a wedge, a failed breakout. So I thought a really credible sell. Best trade of the day, 49. This is unexpected. I expected 2 legs sideways to down. I thought we might get to the 41 close. We might get some sort of vacuum test at the 41 close, but I did not expect 52 to be so big. 50 follow through for the bears, relatively expected. You're probably not going to get just huge consecutive bear bars right here. I think after this, we're going to go a little more sideways to down. 51, a big tail on the bottom. As you can see, somewhat disappointing for a lot of traders. And we're testing the most recent buy climax low, which is the 46 low. So that's the first target for the bears achieved, the 46 low. And, you could argue even some bears sold below 45. They scaled in higher. And they're using this to get out. So a couple reasons to bounce there around the 46 low. And then you get 52, a giant bear surprise. I personally thought we were probably going to get some profit taking in here. I was surprised at how big this got. For me, if I'm short from anywhere in here and I see 52, I'm exiting the trade. I think that, it's hard to just hold and hope you get another bar that looks like that. And it's really probably not going to happen. And you're basically getting a giant gift on a trading range day, right? It's been a trading range day. It's probably not going to turn into a big bear trend day. And if it is, you can always sell lower. And if you sold below 49, you now have, you've made 10 points. And that's pretty good on a day that's pretty small. So I think a lot of traders will just exit. And you can see 53 bounced a lot. And part of the reason was traders were exiting. But I think a lot of times a bar like 53 will close above its midpoint or towards its high and force traders to exit. And if you were still short, you would have lost like half your profit. So I wouldn't worry about the rest of the channel down. I think for me personally, I would just exit above, or I'd exit on the close of 52 if I was short. It's not technically wrong to hold short, but it's a trading range day and you're getting a climactic bar on a trading range day. So it usually just makes more sense to get out. 53, it's a low one short, or I guess bad follow through for the bears, not quite a low one short. Bull bar. And you can see we're near yesterday's low. The whole day was an expanding triangle day. We're near the day's low. The whole day was an expanding triangle day, as you can see. So it was better to be betting on reversals up from the low and reversals down from the high than it was to be betting on, big follow-through bars for traders in general. We ended up getting essentially a second leg down for the bears on 54 and then a reversal up 55. I think bears are going to exit 55. It's really the first okay or the first reversal up, and 54 is the signal bar, 55 is the entry bar. Since we traded above 54, it would have been better for the bulls had it stayed an inside bar, but really not all that good. And again, this is one of those areas where it's probably better to buy below 55 than it is to buy above 55. I still probably wouldn't, I'm sure a lot of traders did. I'm sure it's not a bad trade, but I still think that it's kind of tough to be buying after such a big surprise on 52. We're probably always in short, and it's not really great to scale in against the always in direction. 57, you can see we trade back up to the 55 high. So you buy above 55, you buy more below 55, you use 57 to get out, would be the ideal management there. Or you just don't buy above 55 and you just buy below and you take the scalp. 58, a bear bar closing near its low. It's always in short. You could argue that 53, 55, and 57 are essentially a wedge pullback, 3-push pullback for the bulls, and now we're going to get a breakup to the downside. But I'm not sure how much is left of this. And then 58, or sorry, I meant to say 58 initially. Now 59, bad follow through for the traders who were short, and we have overlap with the 57 low. So traders who bought below 57 could have scaled in and made money. So really not as good as it could be for the bears. We also didn't break out of the low of this trading range, which is what the bears wanted to do. 60, a bear bar, but a big tail. 61, follow through for the bears, but it's a wedge channel down. I think bears are going to exit above pretty much any bull bar. Definitely above 62. Bulls, I think it's reasonable to buy above 62. Take a chance we get back to the midpoint of the day, but it's probably going to be a sideways to up rally and not straight up. I think one of the targets for the bulls is the top of the channel here. Here, or maybe even up here, but I thought this was more likely. 63, follow through for the bulls, but a tail on the top. I think that it's a good enough, surprise on 63 that we're getting a second leg up, but we're probably going to get a pullback first since there's such a surprise bar. You're going to get some profit taking, and the channel down was relatively tight, so bears are getting a chance to sell high after their tight channel, and we're probably going to get bad follow through. So 64, an inside bar low 1, possible bull trap 63, but not really a good short. Disappointing follow through 65, and a bull bar closing near its high 66, an inside bar high 1, but I'd rather wait. And yeah, we pretty much just went sideways the rest of the day. I wouldn't really take anything in here. You could see that we got 3 pushes up, 1, 2, 3, and so 69 was a wedge, so I wouldn't buy below 69, but I don't really want to sell that either because it's a bull bar, and we're probably getting to the magnet. So traders, instead of buying down here, maybe they bought, lower. Well, they clearly did buy lower. Probably 2 legs sideways to down though. So first leg, pull back, second leg sideways to down. Really just confusing tight trading range in here. I would be done for the day. The thing I talked about at the beginning of the day was more just, algorithms. I don't think that's a good trade. Or it's not a bad trade. It's obviously an okay trade if algorithms are taking it, but I just thought it was, interesting overall math. For stop orders today, I thought, 7 was probably fine. But just tough. 16, 17 are good. Maybe 27, but I think tough. 36, 42 is okay. All the bull bars closing to their highs with open gaps, things like 31 or 32 and 34 kind of can definitely be a bit tricky because we had the open gaps and we'd stayed above the moving average all day. So I don't know if those were the worst buys, but just tough spot. And then maybe 44, but when you see 45, I think a lot of traders are going to exit. 46, probably fine. I wouldn't buy the close at 47. I'd wait to see what 48 looks like. And then a lot of traders will exit. Excuse me. We'll exit below 49, and then you get follow through. And bears can sell 49. Probably always in short 51. Getting close anyways, and then obviously always in short 52. I probably wouldn't sell 58. I think it's kind of just not great. And, maybe 62, but again, just not like ideal at this point. Probably a few legs sideways up though. And then I'd be done for the day. I've been using for the daily chart this more often. That shows everything because I just prefer it. Follow through for the bulls. We have, 5 straight bull closes, 3 bull bars closing to their highs. We're probably going to pull back here pretty soon. The question becomes, are we going to close the gap with the neckline of the double top? So it's important to see if we are going to get back to that high. If we do get back to that high, then it'll make this rally less bullish. And if we are not able to get back to it and we get some sort of high 1 setup, we might end up getting a rally. for me, I think, pretty good chance we're going to get back to it, considering the fact that this is probably a trading range now. And if we do close the gap, it'll be, in my opinion, more confirmed that we're entering a trading range. But I just don't see that, this, and then we get this, and then we get another big rally. It seems like we're going to be more sideways here. All right, let's